All right, thank you. So today we are going to discuss the adjustments of the single entity financial statements constructed response question. So that is actually part of the section C of your exam. So we usually have in the exam a question on the single entity financial statement. When we say single entity financial statement, so basically most of the times you will be having the trial balance, and from the trial balance you are supposed to make the statement of profit or loss, statement of changes in equity, and then statement of the financial position. So single entity financial statements, you will be having a trial balance, and we know the trial balance, like obviously there is a debit and credit side of the trial balance. So there will be the things mentioned within the trial balance, for example, revenue on the credit side, and then we have the cost of sales on the debit side. And then we have, for example, the property, plant, and equipment at cost on the debit side, accumulated depreciation on the credit side. So there will be a trial balance, including taxation, inventory, financial instruments. There will be so many things within that. So the trial balance will be given in the exam, and you are supposed to make the statement of profit or loss, statement of changes in equity, statement of financial position. This statement of changes in equity is basically exceptionally tested. Mostly the examiner does not want you to prepare the statement of changes in equity, because this is actually the portion of the equity which you have in your statement of financial position. But if they are asking you to make it, then you can take the closing balance directly into the statement of financial position. Otherwise, the statement of financial position equity portion is exactly the same as the statement of changes in equity, because the closing balance of the statement of changes in equity goes to the statement of the financial position. Alongside the trial balance, there are going to be additional information. Additional information, or you can say the notes. Now, the additional information of the notes is usually about, most of the time, you can say more than 90%. And there are some adjustments which are always tested. Let me write the ones which are 100% tested first. Is, for example, property, plant, and equipment. A definite adjustment usually we have from IS 16. The examiner gives you multiple property, plant, equipment. For example, you have the plant, you have the machinery, you have the equipment, you have the right of use asset. And within the property, plant, and equipment, they give the cost and the accumulated depreciation. And then there's a revaluation, sometimes disposal context over there. So a regular adjustment on the property, plant, and equipment. Then a regular adjustment on income taxes. That is from IS 12. So we do not see the final account question, except like these are always tested. So you never see an exception. You always see IS 16 over there. You always see IS 12 over there. And then one more is the financial instruments. Which is IFRS 9. So you always see adjustment from the financial instruments, IFRS 9. So these are the three adjustments you will always see in your final accounts question, or you can say single entity financial statement question. And then we have some other adjustment, but not every time we see that. For example, adjustment from the revenue, from contracts with customers, which is IFRS 15. Adjustment from the leases, right of use asset, and the lease obligation, that is IFRS 16. Okay, so you will find these adjustments within the single entity financial statement question. And then sometimes from intangible assets, which is IS 38. Okay, and sometimes from provisions, contingent assets, and contingent liabilities, which is IES 37. But the regular ones, which are always tested, is the one over here: property, plant, and equipment, income taxes, financial instruments, and then we have the revenue, leases, and intangible assets. So we are going to discuss it one by one. Now, first of all, you need to understand how to solve these adjustments, and these are simple pro formas or workings, which if you practice on regular basis, then an exam question is going to become quite easier for you. So that is not something difficult. It's something very, very easy to understand. So say, for example, let's discuss the property, plant, and equipment. Now, within the property, plant, and equipment, examiner usually gives you the property, and they give you the bifurcation of that. As for example, you have the land, you have the building part. Why we do it separately? Because land is not depreciated, and then we have the building. Okay, then for example, then we have the plant and machinery. Or for example, we have the right of use asset. So because we will be doing the question on the Excel or the spreadsheet, you need to write these in different columns. For example, if you're using the spreadsheet, write land in one column, and then building, and then plant and machinery, and then right of use. Why I'm not using spreadsheet right now? Because I have to write so many things to explain. So that's why I'm using this currently. So you can use Excel for your spreadsheet for yourself. So first of all, you take the cost, or sometimes you have the carrying amount directly being given within the question. So if there's a cost, you put these figures over here: cost from the trial balance, and then you put the accumulated depreciation. So land is not depreciated. Okay, building, plant and machinery, right of use asset. So then once you deduct the accumulated depreciation from the cost, you will have the carrying amount. And this carrying amount would be at the start of the year. But for example, if the examiner gives you the carrying amount directly, because sometimes they give mix. For some property, plant, equipment, they give the cost. For some, they give the carrying amount. For example, so if you have the direct carrying amount, then no need to put that in cost and accumulated depreciation. Just write directly over here in the carrying amounts. Okay, once you have written this, then there's a thing you need to see, that if there's a revaluation, whether they are doing the revaluation. Now this is something very important. So when you have the revaluation, and mostly you have the revaluation context within the case study, you need to see whether they are doing the revaluation at the start of the year, they're doing the revaluation midway, or they're doing the revaluation end of the year. So these are the three things you need to see when they are doing the revaluation. because this carrying amount, which you have calculated from the trial balance, is the carrying amount at the start of the year. Now, if they're doing the revaluation at start of the year, then directly you need to compare this carrying amount with the fair values, and the difference would be the gain or loss on revaluation. If they are doing the revaluation midway, then you need to charge the depreciation up to the revaluation date, and then calculate the carrying amount on the revaluation date. And if it is end of the year, then you need to deduct the charge for the year. So make sure that these are actually three different practices the examiner follows within an exam question. Start of the year, so you have the carrying amount at the start of the year. Directly compare it with the fair value. Directly compare it with the fair value. If it is midway, then you need to record the depreciation up to the revaluation date, and then you will have the carrying amount on the revaluation date. Then you need to compare with the fair value. And if it is done at the end of the year, then that means you need to charge the complete depreciation for the year. And once you get the carrying amount at the year end, then you can compare it with the fair values. So make sure you are looking at these three different scenarios within an exam question. So cost minus accumulated depreciation minus carrying amount. I'm assuming for this, like for example, they're doing the revaluation by the end of the year, considering the third case right now. I've already explained you the other two. So what you can do is deduct the depreciation for the year. Now remember the depreciation for the year, the land is not depreciated. For building, usually they take the straight line method. Now, this is something you need to remember. If they are asking you to depreciate some assets on the straight line method, then you need to depreciate the asset and calculate the depreciation on cost. If they are asking you to depreciate some asset on reducing balance method, then you need to apply that depreciation rate on the carrying amount. So if it is about straight line method, then you need to take the cost divided by the remaining useful life or whatever the useful life. And then the reducing balance method, you need to apply, for example, for plant and machinery. You need to apply the depreciation rate on the carrying amount. So once you get this depreciation for the year, that's building, plant and machinery, and the right of use, whatever, then again you would have the carrying amount. Now this carrying amount is the carrying amount at the end of the year, at reporting date. So this is again the carrying amount. This was at the start of the year, and this is the end of the year. Now, assuming that they are doing revaluation of, for example, some assets, then you take the fair value. For example, they are doing the revaluation of land and the building. You take the fair value, and the difference between the carrying amount and the fair value is the revaluation gain/loss. So say, for example, it is a gain, then you record the gain over here. But if it is at the start of the year, then this is the point where you need to compare the carrying amount with the fair value. And any gain or loss will go to the other comprehensive income. And then you need to make sure that you're applying the depreciation on the revalued amounts and over the remaining useful life. In that case, don't depreciate the carrying amounts at the start of the year, because you have revalued assets. When you have revalued the assets, then the depreciation should be applied on the revalued amount and remaining useful lives. And if it is midway through the year, say for example, considering exactly midway through the year, so calculate the 6 months depreciation and then calculate the carrying amount and then compare with the fair value. Now the depreciation should be charged on the fair value, which is the revalued amounts, and over the remaining useful life. But remember, you need to again do the pro rata basis because 6 months are only there. So this is something very important. If you understand this point, then that means you have got the complete marks within this property, plant and equipment adjustment. So this is the basic performer of the property, plant and equipment. And say, for example, if they're disposing of some assets, for example, they have, let's assume they say they have the plant and machinery balance. Within this balance, there is some plant and machinery which has been sold. So just take it out from this balance and do it separately. Because sometimes they sell it at the start of the year, sometimes they sell it midway during the year. So just bifurcate the cost of the existing plant and machinery and the sold ones, so that you get the correct depreciation. So this is the property, plant and equipment adjustment. This is the first one. We are done with this. Okay. Then the second one is the income taxes, which is again something very important. Income taxes, IAS 12. Yes, there's one more thing I need to tell you regarding this. That okay, this depreciation for the year is usually they tell within the single entity financial statement question that the depreciation should be charged. Usually it says to cost of sales. So you need to take this complete depreciation for the year and add it to the cost of sales. And then these fair values. So this fair value, and then these two are going to be added, and these go to the carrying value of the property, plant and equipment in the statement of financial position. And these revaluation gains and losses, they go to the other comprehensive income. Unless, for example, there's a loss on the asset which was previously revalued. So basically you reduce the revaluation surplus of that directly. And if that was not previously revalued, so that means that goes to the profit or loss. In that case, the revaluation loss goes to the profit or loss. Okay, then coming towards the income taxes, which is IAS 12. Now within IAS 12, again, there are two things. First is the current tax. Okay, we have the current tax. And then we have the deferred tax. Okay, whether the current tax or deferred tax, for financial statements, one figure goes to the current liability, one figure goes to the non-current liability, one figure goes to the statement of the profit or loss, tax expense, tax figure within the statement of profit or loss. So this non-current liability and current liability is within the statement of financial position. Now, how we can calculate it? So there is a basic working again. So you will be having the trial balance. Again, the trial balance has two sides, debit and credit. So they say, for example, the tax and the deferred tax. Usually with the deferred tax, they have the credit balance, which is actually the deferred tax liability. But the current tax may be the tax may be the debit balance and the credit balance. If it's the credit balance, then this represents over provision. Remember, examiner is not going to tell you this thing. They say the balance in the trial balance represents the under or over provision. So you need to remember yourself. If it's the credit balance, it's the over provision. If it's the debit balance, then it's the under provision. And the deferred tax is usually this, if it is on the credit side, and this is the deferred tax liability. And remember, this is the opening balance of deferred tax liability. And if it is, for example, coming on the debit side, then that represents the deferred tax asset, but usually we do not have the adjustment from the deferred tax asset. It can come in the exam, but mostly we see from the deferred tax liability. So this is the situation. And then alongside it gives you the additional information. Now within the additional information, they give you few things. Current year tax provision. They say the estimate of the current year tax is this. This is known as current year tax provision because this is an estimate of the current year. They give you that figure. And then they give you the information regarding the closing balance of deferred tax liability. And sometimes they give you directly the closing balance of deferred tax liability. Sometimes they give you the taxable temporary difference by stating that the carrying value is more than the tax base. So that is the taxable temporary difference. Then you need to multiply it by the tax rate in order to calculate this closing deferred tax liability. Sometimes they directly give you the closing balance of the deferred tax liability. And sometimes they give you the taxable temporary differences multiplying by the tax rate, and then you get the closing deferred tax liability. Now, what is the working? So first of all, you need to take the current year tax provision, which is the current year estimate. And then if there is the under provision, that means you recorded the less tax expense. So you need to increase your tax charge. If there is over provision, that means you recorded more. So if there's under provision, that means debit balance in the trial balance, as I have shown you. Then you need to add in this expense. If there is over provision, then you deduct it. If there is increase in the deferred tax liability, then that represents expense. You need to add it. If there is decrease in the deferred tax liability, then that represents the decrease in expense. And then you need to reverse it from the expenses. So the net figure you get is the tax expense figure that goes to the statement of the profit or loss. Now, this represents your current liability. This is your current liability. And this is your tax expense within the profit or loss. And then how you got this increase or decrease in deferred tax liability. So you compare the opening balance of deferred tax liability with the closing balance of deferred tax liability. And then the difference is the increase or decrease which goes over here. And remember, this closing deferred tax liability is your non-current liability. So this is the most simple adjustment, but remember that this thing is without revaluation. Like obviously there would be revaluation context, as I told you in IAS 16. And then they say the revaluation give rise to the deferred tax liability, or they say ignore the deferred tax on revaluation. So this scenario which we have discussed is ignoring the deferred tax on revaluation. But what if they say there is a deferred tax consequence on revaluation? So in that case, the working will change a little bit. You take the closing balance of deferred tax liability. You deduct the deferred tax on revaluation from it. There would be the revaluation gain. You take the deferred tax on revaluation, you deduct it from this, and then you compare it with the opening balance of the deferred tax liability, and then the increase or decrease will be calculated. This will give you the increase or decrease. Again, the increase increases your tax charge, so you add it over here. Decrease in deferred tax liability decreases your tax charge, so you deduct it from this working. And this closing balance of deferred tax liability is again your non-current liability. So we have discussed two final accounts adjustments so far, and these are pretty simple if you just remember the formats. So this first one was a property, plant, equipment. We are done with it. And then we are done with the income taxes, IS 12. Okay, now we are moving to the third one, which is again a regular adjustment in the single entity financial statement question, and that is from the financial instruments. Okay, so within the financial instruments, the things we regularly see within an exam question is the loan notes / debentures or debentures, which are recorded as the financial liability at amortized cost. So these loan notes and the debentures, which are recorded within the non-current liability, the treatment of this is to record the financial liability at amortized cost. Now there's a working for this amortized cost. So you take the opening balance of financial liability. Opening balance of financial liability. From where you're going to get it? From the trial balance. And then remember, you add the interest on it. Let me just use a different color in order to distinguish it. So add, and then we have less. Two things. You need to add the interest. And remember, the interest is on effective rate. The effective rate will be given in the exam, in the additional information. Interest on effective rate. So what do? You take the opening balance and then you multiply it by the effective rate percentage. So you get this interest figure over here. And then we have the payment. Payment is always on the nominal rate. So what you do is you take the nominal value or the face value of the bond, multiply by the nominal rate. So how nominal rate is given usually with the bond, like when you see the trial balance. In the trial balance, it says, for example, 6% loan notes. Now 6% loan notes, and then there's a balance. So this 6% is actually the nominal rate. So you take the 6% nominal rate, so nominal value into nominal rate, and then you get the payment stuff. You deduct it. Then you get the closing balance. Closing balance of financial liability. Now remember, if the bond or loan notes, whatever you call it, if the bond is issued during the year, then you need to do the months by 12 because the interest is for the year. So you need to multiply it by months by 12. Now, this interest on effective rate goes to the profit or loss as finance cost. This is your finance cost. And this closing balance of financial liability is your non-current liability in the statement of financial position. Now, sorry, this was related to the financial liability. Now, if you have something related to the financial asset, now financial asset, usually they describe you of two types. So you will find within the trial balance, there would be an investment figure, and that is the opening balance. So financial assets are of two types. Financial assets, which are the investments made in equity instruments and for short-term intention, for trading intentions, for speculative purpose, that is recorded financial asset at fair value through profit or loss. That means at each reporting date, you're going to remeasure your financial asset, and any gain or loss, any fair value changes are reported in the profit or loss. And then we have the financial asset for strategic intent, long-term intention, which is the alternative treatment, that is fair value through other comprehensive income. So what you need to do is you take the opening balance from the trial balance. So this is you get from the trial balance. And then you get the closing balance from the additional information of the notes. And this is actually the fair value at year end. And the difference between these two is the gain or loss. Now, if it is the financial asset through profit or loss, then the gain or loss goes to the profit or loss. If it is the financial asset at fair value through the other comprehensive income, then the gain or loss goes to the other comprehensive income. So these are the two adjustments that you get from the financial instrument usually. But in addition to this, sometimes we get the convertible loan notes, in which the bondholder has the option that they can convert their investment into the cash. Like on maturity, they can take the cash, or they can take the shares from the company. Now, obviously, it is the bondholder who will be deciding what they will be doing at the maturity. How the company will be recording this convertible loan notes. So the convertible loan notes are recorded named as split accounting. Split accounting means that you need to distribute your convertible loan note into the debt portion and the equity portion. Equity portion is actually the remainder as a balancing figure. So there is a very, very easy format. So first of all, you take the year column. Again, you will be doing in the Excel, so to make the year column. And then we have the cash flow. And then we have the discount factor. And then we have the present value. So remember, for example, if the bond is for 3 years, in the year 1, you only have the interest. Now remember, this is the payment thing. So how we calculate it? We take the nominal value of the bond into nominal rate. In the second year, again, it is interest. So say, for example, there is $1,000 bond with a nominal rate of 10%. So in the first year, it would be 10% of 1,000, which is 100. In the second year, it would be 100. In the third year, it would be the principal amount plus the interest. Now the principal amount is 1,000 plus the interest of 100. Then you need to bring it to the present value by using the discount factor. Remember, this discount factor is not the nominal rate that you would be using. Nominal rate is for calculating this payment. This would be the market rate given in the exam. So say, for example, if it is 10%, it may be, for example, 12%, let's assume. So 12% market rate. Again, the formula, you know that 1 plus r raised to power minus n. Usually the discount factors are given in the exam. But for example, if no, then 1 plus 0.12 raised to power minus 1 raised to power minus 2 raised to power minus 3. And then you get this figure over here, and over here. So this is the total value that we get, and this is known as the present value. And this is the debt portion. The present value of the debt portion. Then you compare it with the nominal value of the convertible. So this is the present value of debt. This is the total nominal value of the convertible, for example, this 1,000. And then the balancing figure is the equity portion that is recorded in the other components of equity. It's not other comprehensive income, it's other components of equity. Okay, so this OCE figure goes to the OC statement of changes in equity, and then this figure comes in the working of the amortized cost, which is the opening balance, and then we add the interest, again on effective rate, and then we deduct the payment on coupon rate or nominal rate, and then we get the closing balance. So remember, we need to understand how they are going to be recorded within the financial statement. This is your non-current liability. This is your finance cost. And this is your OCE figure within the other components of equity. So there are basically 3 figures. 1 in the OCE, 2 in the finance cost, 3 in the non-current liability. So we are done with the 3 adjustments. We have discussed, yes, the property, plant, and equipment. We have discussed the income taxes, and we are done with the financial instrument. So remember, these are the easy marks, and even the multiple choice question or objective test questions works on the same way. The same workings are used to calculate the objective test questions if you're having from these standards, and the same working to calculate the adjustment within the final accounts. So this is all about today. We are just doing 3 adjustments, and in the next session, whenever we will be having, we will be moving to these ones: revenue, leases, intangibles. So hope you understood the PPE, income taxes, and the financial instruments.